Ford is being ranked as one of the best dividend stocks to buy despite a fall in its EV segment, so should you buy the stock? Sit tight as we take you through the pros and cons of owning Ford stock. But before we do that, subscribe to our channel $1 World for regular F-Stock updates. Investing in stocks stands out as a premier strategy for generating substantial long-term wealth. The strategy becomes even more appealing when a company rewards its shareholders for their ownership through dividends. The concept is simple. The higher the dividend yield, the greater the value delivered to investors. Now let's delve into the factors that position Ford Motor Company as a widely favored and indisputable choice for dividend-oriented investors, boasting a remarkable yield of over 4.6%. What truly sets this apart is the staggering contrast in outcomes. A significant concern among investors, particularly regarding the iconic Detroit automaker, is the stock's perceived failure to fulfill its potential by not achieving substantial growth in share price. This viewpoint holds merit, considering that despite achieving record profits in previous years, the stock price often found itself in a state of stagnation. Nonetheless, let's draw a comparison between Ford's historical stock price performance and that of the S&P 500 index. We'll first examine the respective trajectories individually and then factor in the impact of reinvested dividends. The distinction between these scenarios is undeniably striking. When analyzing Ford's returns solely by its stock price, the growth might seem relatively lackluster compared to the overall market represented by the S&P 500. This observation could understandably lead to some disappointment among investors who are focusing solely on capital appreciation. However, the narrative changes significantly when we introduce the concept of reinvested dividends. Dividends are essentially a share of the company's profits distributed to its shareholders. When these dividends are reinvested, meaning they are used to buy more shares of the company's stock, the power of compounding comes into play. Over time, this can substantially enhance the total returns for investors. In Ford's case, the dividends it offers have a notably high yield, which means they constitute a significant portion of the investment's return. When these dividends are consistently reinvested, the effect can be truly transformative. This is the key factor that makes Ford an unmistakably appealing option for dividend-focused investors. In the past, many investors were deterred by the lack of long-term perspective exhibited by Detroit automakers. This myopic approach ultimately had adverse repercussions for both Ford and General Motors, as they dismissed the notion that the popularity of gas-guzzling SUVs and trucks could decline. However, this dismissive stance proved costly when these larger vehicles faced formidable competition from more fuel-efficient alternatives, especially as gas prices escalated. The repercussions of this short-sightedness were felt by the automakers for an extended period. Fast-forwarding to the present, the scenario has taken a different turn for Ford. The company's management is now steering clear of repeating past mistakes. Ford has adopted a proactive strategy by channeling substantial capital into reshaping its future within the electric vehicle landscape. Equally noteworthy is the fact that Ford's conventional gasoline-powered lineup remains financially rewarding enough to not only finance its transition but also sustain its dividend distribution. This strategic shift reflects a recognition of the evolving market dynamics and the importance of adapting to changing consumer preferences, particularly with the growing emphasis on environmental sustainability and energy efficiency. Ford's strategic allocation of resources towards electric vehicles positions it well to capitalize on emerging trends, while simultaneously safeguarding its financial stability and commitment to dividend investors. This proactive approach stands in stark contrast to the previous short-sightedness that had hampered the automaker's growth and resilience in the face of market shifts. Enjoying the video so far? Be sure to join our Discord community to connect with other like-minded investors. Indeed, Ford's recent performance speaks volumes about its financial strength and stability. During the second quarter, the company achieved an impressive 12% increase in revenue compared to the previous year, and its net income nearly tripled, reaching $1.9 billion. Furthermore, both cash flow from operations and adjusted free cash flow demonstrated robust figures, standing at $5 billion and $2.9 billion respectively. Notably, Ford's financial position is bolstered by a substantial cash reserve of nearly $30 billion, along with a substantial liquidity of over $47 billion. In essence, these robust financial metrics signify that Ford's dividend is secure, barring unforeseen circumstances like another pandemic or a significant economic downturn, both of which, as history has shown, are potential but unpredictable events. Adding to the reassurance, there are a couple of additional considerations to take into account. Ford's strategic decision-making has included a focused approach on its more lucrative business segments. For instance, the company has made strategic moves such as gradually exiting most passenger car segments in the North American market. Moreover, Ford has taken steps to discontinue production in South America, a region that had previously incurred substantial losses, amounting to over $12 billion. These strategic actions reflect Ford's commitment to optimizing its operations and prioritizing profitability. Another noteworthy aspect is Ford's track record of issuing special dividends. A prime example is the recent case where Ford capitalized on its early investment in Rivian, an electric vehicle manufacturer, and subsequently rewarded its investors with a notable special dividend of $0.65 per share. This practice underscores Ford's ability to leverage its strategic investments for the benefit of its shareholders, further enhancing its appeal as a dividend-focused investment option. Following a robust second quarter, Ford has revised its full-year outlook upwards. With ample resources at its disposal, the company is well equipped to manage the shift towards electric vehicles while also rewarding its shareholders. Notably, Ford is targeting a substantial portion of its free cash flow, ranging between 40% and 50% to be allocated towards shareholder returns, even in the scenario of significant challenges affecting the automotive industry, leading to a potential pause in dividend distribution. Ford's overarching objective remains focused on maintaining a resilient and stable dividend in the long term. Presently, Ford's stock features an attractive dividend yield of 4.6%. While this dividend is reinvested over time, the cumulative difference in value for investors becomes substantial, reinforcing its position as an evident choice for generating passive income. Furthermore, the appeal extends beyond dividend income, as Ford's strategic positioning for the future of EVs comes into play. The company anticipates achieving an impressive 8% adjusted EBIT earnings before interest and taxes margin within its EV business by 2026. This projection indicates considerable growth potential for investors, further enhancing the investment proposition. Let's look at how the Ford stock is performing on the market. As of August 7th, 2023, Ford's stock is priced at $12.89, with a day's trading range showing a high of $12.91 and a low of $12.80. Over the past year, the stock has seen a range between its 52-week high of $16.68 and its low of $10.90. Starting at an operating value of $12.80, the stock market closed at $12.89 on the same day. The trading volume reached 48,412,895 shares, contributing to a market capitalization of approximately $51.59 billion. On this specific day, Ford's stock exhibited a 0.55% increase, reflecting a modest upward trajectory. This aligns with its recent performance, where the stock has shown a gradual ascent of more than 10% since the start of July. This upward trend can be attributed to several factors, including the company's favorable earnings report and the general positive shift in the broader stock market. Within the online community and among Ford's stakeholders, distinct divisions have emerged, primarily falling into two prominent factions, the bullish and the bearish. These contrasting perspectives reflect a wide range of opinions on the company's future prospects. The bullish camp is marked by individuals who hold an optimistic outlook on Ford's potential, likely driven by factors such as the company's strategic moves towards electric vehicles, positive earnings reports, and overall market sentiment. On the other side, the bearish faction harbors more cautious sentiments, possibly owing to concerns about industry challenges, global economic conditions, or past stock market performance. However, it's worth noting that a smaller segment exists, comprised of individuals who remain neutral and unaffected by the ongoing discourse surrounding Ford's stock. These distinct viewpoints underscore the dynamic nature of the investment landscape and the diversity of opinions that contribute to it. To end it off, Ford may be looking weak right now in terms of its EV segment, but that alone does not shape the stock's value. Remember that this is not financial advice and you should always do your own research and make informed investment decisions. That was all for today. Let us know if you think the stock will make you rich or not in the comment section. Hit like and subscribe to our channel $1 World for more such penny stock videos, and we will see you in the next one.